Good afternoon, everyone. I'm Nancy Malberg, and I'd like to thank you for joining us for the third of our four-part series on succession planning. For many business owners, selling the company is the largest financial transaction of their lifetime. Statistics show that businesses that achieve the best outcomes are not the ones that wake up one day and just decide to sell. They're the ones that plan for years in advance. Today, we'll discuss what drives the business value, how buyers can evaluate opportunities, some common deal structures used in transactions, as well as the steps owners can take to position their companies for a successful transition. So, whether your goal is retirement, a shareholder transition, or exploring for future growth opportunities, understanding the process and preparing early can help you maximize the value, reduce your risk, and create more options when the time is right for you. So, with that, I would like to turn it over to Nikki Grollup. Nikki, take it away.
Thanks, Nancy. So we're going to jump into really what's the process when we're selling our business. This is where it gets to be the fun stuff. So why are businesses sold? What is a typical sales process? And who's on your team? So with that, we'll jump into why businesses are sold. So typically, businesses are sold for various reasons. They might sell because the owner's looking to retire and move on to the next phase of life. It might be a strategic opportunity. So a business might want to, it might want to grow, but it might be capped out based on where it's at. So if it brings in a partner or sells, it might accelerate the growth of the business to the next stage. There might be shareholder transitions, so it's not, and not every shareholder wants to get out, but certain shareholders do. So you're really just changing the capitalization of the company and the owners of the company. And then capitalization and liquidity needs. So oftentimes, business owners know that a lot of your liquidity is within your business. So if you need some liquidity outside of your business, a lot of times you might recapitalize the company to get that liquidity. And oftentimes we'll see a recapitalization happen when people want to take some chips off the table before an ultimate sale down the road. So the process, I've boiled it down into 8 steps. It seems so simple, but there's a lot to each step. So the first step is you're going to do preparation and readiness assessment. So we've talked extensively about this. Really, are you ready? Is the business ready to sell? So once we get to that point, then a lot of times this is where we'll jump in and somebody is like ready to sell, business is ready to sell. We've done our assessment. What do we do next? So we're going to want to go through a business valuation. The reason for that is a lot of times, you know, business owners have done quick calculations, they have an idea. Well, we really need to get a really honed in idea of what the value of this business is. So we can position it. Who's the best buyer for this business? What is our ideal purchase price? What are we willing to accept or not accept? What's a deal breaker? Once we've done that process, then we'll go into the marketing and buyer identification. So how are we going to, are we going to have a business broker? How are we going to get in front? Do we know? Do we have contacts within the market space that we want to reach out to? Do we know strategic buyers? Let's reach out to them. So really identify. Maybe it's an internal person. Let's identify that person and see if they want to move forward. Maybe it's a family member. Then we're going to do buyer screening and confidentiality. So we're in the driver's seat at this point. We get to determine what buyer makes the most sense. So a lot of times we will want to have multiple buyers, right? We want competing purchase price and fundamentals of the transaction to get the best for what's for the business and get the best for the selling partner. So you're going to do screening, and then ultimately, before we give any information, we want some confidentiality. We need a non-disclosure agreement because we don't want to give any confidential information. Even after we have the non-disclosure agreement, we will layer in what information we give. And if we have trade secrets and other things, those come last within the information that we're willing to provide. Then we're going to receive an indication of interest or a letters of intent. So what those really do is those are going to tell us, hey, these are the transactions that we're looking to, this is what we intend to do, and this is how we're going to do it. So a letter of intent or an indication of interest is non-binding. So what that means is that if this is what we think we want to do, we need to get through all the next steps to make sure that that all comes to fruition. If I can give you one thing, it is to do to get your letters of intent really sound. Because if they're really sound, then that means that you've agreed on a lot of the big fundamentals, which is going to be really important and it's going to help you in the future. And so once you have a letters of intent, and you can start doing negotiations even during this time frame. If no, I'm not willing to accept that of intent. However, if it had these type of parameters, this would be acceptable. So once we get that acceptable, we've signed that, we're going to move to due diligence phase. So this is the phase really where, and we talked about, you're going to go over legal, financial, all areas of due diligence in order to identify, the buyer is going to identify, are there any issues? They might do a quality of earnings to make sure that the earnings that you've reported are accurate. This is where we want to make sure we have really good financial data. And then we're going to move on to negotiations of the definitive agreement. So this is very attorney intensive. There's a lot of legal language within there, as well as the letters of intent. But really, this is going to be the agreement that is a binding legal contract on the sale of the business. So this is going to have a lot of different components in it that need a lot of attention to make sure that they're exactly meeting your objectives. And then it's closing day, which is really exciting. Not to lose sight of any post-closing transactional commitments that you made. So during those post-closing transactional commitments, really need to identify, well, what's my obligation as the business owner? What's the financial obligations pre-close and post-close, to make sure that you're rounding that all out appropriately. So there are only 8 steps, but those 8 steps are very encompassing. And then who is on your team? A lot of times people will ask this question. You might have an investment banker, an M&A advisor, a broker, to help bring potential buyers to you. You'll have a CPA and tax advisor that will help you get the best tax outcome for your transaction, and also could be the quarterback to the transaction. You'll have a transaction attorney. So we talked about there's legally binding documents. Nobody else besides the attorney will draft legal documents such as your letters of intent, or advising you to sign the letters of intent, and all of the closing statements, the definitive agreements. And then you'll have a wealth advisor. So what am I going to do with my cash after this? What does that all look like? You'll have a wealth advisor on your team that's going to assist with that transaction. So what are common deal structures in transaction considerations? So we'll talk about the deal structures, purchase price components, and tax and financial factors that you should consider. So in an asset sale, so really when you look at selling a business, you're going to look at one of two things. You're going to look at an asset sale, or you're going to look at a stock sale. An asset sale is common for lower to middle market transactions. Buyer receives only the selected assets and liabilities, and then you can decide, right? There might be excluded assets from the sale because the business owner wants to keep this. A lot of times I'll see that as vehicles, right? My vehicle is within the business, so I want that to be an excluded asset. And oftentimes buyers prefer this transaction because an asset sale, when they buy the assets, the basis of their assets are going to be what they paid for it, versus a stock sale, they're just going to take over, and what you pay for the stock is stock basis. But if you have a lot of depreciable assets, you don't get to restart depreciation on those fixed assets, which is very important to consider. A stock sale, the buyer acquires the entity. So this is the easiest, right? Because the entity just continues on. You don't need to change the name. You don't need to change EIN numbers. You don't need to change bank account numbers. Everything just continues as normal for the business. Oftentimes, this is frequently preferred from sellers because oftentimes, if it's a stock sale, it will be treated as a stock sale, which is a capital gain type transaction, so at a lower tax rate. So other common structures to consider, well, strategic sale, we've talked about that. That's to get the best value. Private equity recapitalization. So really looking at should we bring somebody on to help recapitalize the business? So I might, if I'm the business owner, I might not be getting out. Let's say I'm bringing in private equity for 49% of the company. That's going to infuse cash into the company that we can help leverage and use it to grow the company. A management buyout, so that's your management team structuring a buyout, or an ESOP transaction. ESOP transactions work really great in the right situations for the right companies. There is an upfront spend associated with them, but there's a lot of tax and financial advantages to an ESOP. So sometimes ESOPs can be very confusing, and sometimes they get overlooked in the right situations. So you have to have a medium, a mid-sized company that is stable, that has a really strong management. You have a really strong management group, definitely would be of consideration. And what are the purchase price components? Well, cash is king. So cash at closing, we're always pushing to get the highest amount of cash at closing. That takes as much of the risk off the table for the seller as possible. Then there might be a component of seller financing. So, there maintains a risk within that. So we try to limit that as much as we can and have third-party financing as much as possible. Earnouts. So typically I like to maximize cash at closing, and then the earnouts are really just icing on the cake because you lose control of the factors that are the components of the earnout. So I hate to have somebody relying on the earnout and not get it, but a lot of times earnouts can be part of the negotiations to increase the potential purchase price. And then an equity rollover. So a lot of times you might not sell 100% of the company. You might maintain a certain percent of equity rollover. So now you're going to be partners with the buyer of the business. So what does this all mean? Well, really what this means is we're trying to maximize after tax proceeds, and we're doing that on various ways. So we're looking at how much is taxed at ordinary income versus capital gain. That's where we get to the asset sale, stock sale. Even if we have an asset sale, the allocation of that purchase price is really important. Working capital adjustments. So typically there's a working capital target, and that target is then included in the purchase price. So need to understand, well, what is that target? How is it calculated? And then what is the true up going to be? Because that's ultimately going to change the purchase price for better, increase it or decrease it. The purchase price allocation, how much is allocated to each bucket or types of assets, that can have a big tax implication that you really need to factor in. And then state tax implications. So, what is your ultimate overarching, and is there some state tax benefits that you can take via purchase price allocation?
Thanks, Nikki. So what buyers evaluate during a transaction? So recognize the gaps that buyers will scrutinize, but sellers can work on before they put their business up for sale. Typically 3 to 5 years in advance, they would go through a de-risking process to kind of clean up some of these gaps. And these gaps include operational gaps, financial gaps, what buyers may reward or discount at the table. All right, this goes a little bit further into operational gaps. So basically what a buyer is going to do is they're going to look for these gaps which equal risk. So the gaps include owner dependence, employee and workforce, process and procedures, concentrations, legal exposure, and technology. All right, probably the biggest value killer is going to be owner dependence and too much dependence on that owner. So this is where the owner is the best salesman, the top technician. They have all the contacts with the customers and suppliers. So this business is worth little without the business owner. So how do we fix this? So first is we go through and we systemize our approach through process and procedures. We build a strong leadership team, and we try to make the business more than just the owner. We're looking to build a brand. And so we do this by developing the staff and their technological expertise and make them a little bit more forward facing. So the face of the business is many more people other than the owner. All right, to continue on with the employee and workforce, we like a strong management team, one that can function without the owner. We like long-term employees that know what they're doing, who have bought into the company culture and diversification of duties. So from a buyer standpoint, we're looking for these areas to be strong. All right, process and procedures. First is we like to document them so we know who is responsible for what. And then after we document them, we want to review them to make sure that everybody knows what they're doing. We're looking for process or for efficiencies, inefficiencies. We're looking for places that we can improve. So the result is going to be a more consistent product that is repeatable, and we know who is accountable for each step of the job. So the idea here is to make this whole process repeatable in case I get a new employee. There is a handbook, there is a manual showing them exactly what they can do or what they are responsible for doing so they can get up to speed that much faster. Or if I want to open a location in a different state or in a different town, I have the blueprint in place that is very easy to do that. So the blueprint to grow and expand. Concentrations. From a buyer aspect, this is risk. And from a seller aspect, you would want to diminish this as much as you can by, number one, broadening your base for customers, right? So if I had 2 customers that make up 40% of the sales, what happens if they leave? Well, of course, the business is going to be worth less without them. Next is concentration in the product line. We don't want a heavy reliance on one particular product or industry. So there's a picture of Blockbuster Video there. So Blockbuster was very reliant on one particular product, and that product and market changed ever so slightly, and basically they went out of business because of that. Next is concentrations in suppliers. We do not want a dependence on a single supplier. What happens if that company goes out of business or they raise their prices? So we want to have some backup options for these vendors. Legal and compliance. So from a buyer aspect, I want to make sure that I know if there's any sort of pending legislation or violations with the company, make sure the contracts are up to date and maybe bulletproof. If there's intellectual property such as patents and copyrights, I want to make sure that those are current and up to date. So if I buy those, they mean something. Next is tax risks. With the advent of the internet, it's so easy to sell in 50 different states, but along with that comes the sales tax implications of that. So maybe I have to file in 50 states now, or if I file in 50 states and it's so easy to have remote employees nowadays, maybe I have an employee in Ohio, and what does that mean for nexus regions? Do I have state tax implications? And the same with aggressive tax positions. If the previous owners were very aggressive in the positions that if they've taken and I buy the stock of the company, now all of these problems and skeletons become my problems. Next is employee risk. There's a risk if there's high turnover. What is the culture of the company? Is it bad? And that's why there's turnover. Key employee dependency that are not locked down with employee contracts and non-compete agreements. We don't want these guys to be our next competitors tomorrow if the business is sold or if I buy it. All right, on to financial gaps and numbers. We accountants love numbers. So we have earnings quality, EBITDA adjustments, working capital, balance sheet, tax exposure, which we kind of talked about, and due diligence ready. All right, first is earning quality gaps. We talked about customer concentrations. Next is if we're looking at the EBITDA number, I'm looking for one-time adjustments that may be on there. Right. So last couple of years we had PPP adjustments, we had ERC, that employee retention credit. Maybe the company discontinued a line of product and they sold all the assets. So there's a one-time bump in bottom line. Maybe there's insurance proceeds. So we don't want to base our sales price on one-time bumps in income. Revenue recognition and cutoff issues. This could be done maliciously or non-maliciously. So let's say I was an unscrupulous seller. I could push income from 2025 into 26 and pull income from 27 into 26 so that 26 artificially looks better. And if my sales price is based on a good 26, maybe it's not the right picture. Next is cutoff issues. This may be with poorly trained accounting staff with the company. Maybe they're just posting sales to the incorrect year. Next is weak, late, and inconsistent records. We'd like to see that the financial statements match what's on the tax return. We'd like to see that there's ability to get financial statements out relatively quick after the end of the month, and we can rely on those financial statements. They're not looking kind of garbage. This leads us to the EBITDA adjustments. Some of these things can be adjusted through normalizing the income, but if I was a seller, I'd want to clean this up a couple years in advance. Some examples of this is going to be excess owner salaries or not enough salary. It could be family on the payroll, but they're not really doing anything. It could be sneaking personal expenses through the business or discretionary expenses that maybe belong, but I really don't need them. So maybe there's travel, excessive travel. We have the Corvette on the books. Maybe there's club dues. So I would want to clean that up in advance, not have those adjustments in the year of sale. So we want to have financial statements that the buyer can trust. Working capital. If I was buying the working capital, I would look at the accounts receivable and the balance is at over 90 days, 120 days. If there's a lot of those, it could be there's some collection problems, or maybe you have a bunch of customers who are unhappy with the service, therefore they're not paying or they're going to pay late. Same with the inventory. I would review the inventory to see, are there obsolete inventory on there or slow moving inventory? Well, I don't want to buy garbage. It's non-existent assets, the receivables and inventory. If cash was not part of the deal, maybe I look at accounts payable to make sure that that number isn't building because they're not paying their payables and they're keeping the cash for themselves. Or if there's unrecorded liabilities, moving on to the balance sheet, such as unrecorded warranties, unrecorded legal claims, maybe so there are some environmental issues that are not being disclosed. These are all skeletons that if I buy the stock, become my problems. Tax, we talked about that, but in addition to what we talked about, there could be some payroll issues. Some companies may classify employees as contractors, so there may be some liability hanging out there with that. All right, from a buyer's point of view, what makes a business attractive? So we're on the left-hand side here. So customer loyalty, reoccurring revenue, long-term contracts. Basically what that does is that makes cash a little more steady and predictable, and we like that. They have a strong management team with staff that's been around for a while. Going to the financial statements, they have strong results and relatively good financials that you could trust. Basically, this all equals a company that is low risk. Now, some points that make a company less attractive. We have too owner dependent. Low brand awareness, customer concentrations we talked about before, one-time or seasonal sales where the cash flow is a little bit up and down, a little bit less predictable, less attractive. Getting onto the financial statements, they are below average in results, or maybe you can't rely on them. So the last one is going to be low barriers to entry. This could either be towards third-party players that come and open a business across the street? Is it easy for them to do that? Or it could be your best technician is not locked down with any sort of non-compete agreement, and now you buy the company and he is your competitor across the street. All right, the role of due diligence in a business sale, and again, this would be from the buyer perspective. So basically what they're looking to understand when they go through the due diligence is, am I comfortable with this purchase price? Do I feel like I'm getting ripped off, or is it a fair price? And I want to look at the risk factors and see, am I able to tolerate the risks involved, right? So no company's going to come without risk, but I want that built into the purchase price. The key functions of due diligence is number one, verify the accuracy of seller representations. I'm basing my decisions on things that the seller is telling me, and are they being truthful on that information? Identify risks associated with operational and financial gaps. We talked about that. We want to confirm that the value that I can pay this loan off with the operations of the business and the assets that I have purchased. Next is facilitate transition and integration planning. If I'm buying this business as an addition to one I already have, how does this fit into my business? Or if this is standalone, how am I going to fit in with this company that I'm buying? Am I going to be able to fill the gaps left by the previous owner? And finally, it provides leverage for negotiating price and terms. All right. So we get to the end of due diligence, deal or no deal. So we have three options here. Number one is deal. We like the purchase price. We like what we've seen. We're ready to proceed with the numbers as planned. Number two is we like it, but we like it under different terms. We want to change maybe the purchase price, the terms. Maybe as a seller, I want more cash up front. And number three, finally, is no deal. And this is where we do the due diligence and we find out there's just too much risk with this, or the purchase price is too high. Maybe it's too owner dependent. Maybe it's time to walk away and look for a different deal.
All right, so Craig talked about diligence, what we need, what are some drawbacks, or some things that we should prepare ourselves for. We're going to talk about negotiating priorities and hopefully a smooth closing. So in the sake of time, we've mostly covered the diligence. We just need to, hone in that we're prepared for diligence because it can be a very intensive process. Also, you need to make sure that your advisory team and your employees and yourself as a business owner all have the time and attention it needs to get through diligence. Your day continues on, your work continues on. You need to make sure that everything is continuing as it had been before before you entered into the LOI and potential close. But then you also add all this extra work on top of it. So it can be quite an intensive process that you need to make sure that you're ready for. So what are negotiating priorities? So purchase price is a big one. Purchase price might be number one for one company, and it might be number four for, as far as priorities go for another company. So we really understand what your priorities are to make sure that we can negotiate what's best for you in the business. Next, we'll talk about structure and tax consequences. So we don't always let the structure and tax consequences make the decisions, but it helps us make decisions. Once decisions have been made, we can make them knowing what's going to happen. We'll have a tax analysis done up, and then we'll make changes along the way as we're negotiating, so we know exactly what this means to the transaction and the tax cost. Indemnification provisions. So, right, we need to know what those provisions are and what that means to us in the future. Working capital targets, we already touched on a little, but there is negotiation within there to make sure that those numbers are complete and accurate. You want your target to be as accurate and complete as possible because you don't want any surprises post-transaction that the working capital, let's say the target was too high and you're lower than that, and you need to come up with that. You need to come up with that cash post-close to true that up. And employment and consulting agreements. So what does your commitment look like post-transaction? So really need to look at what that looks like and what you're committed to. And let's talk about common challenges. So surprises during due diligence. That's why you did so much planning in advance, is to limit those surprises, but there typically is a surprise you didn't see coming. So just be aware of that and ready to jump on it. Financing delays. So we know that typically these require an appraisal and other things, and those take longer than they ever have before. Unresolved legal or tax matters, that could be a deal breaker, or it could alter the deal structure or terms. And misalignment on post-closing expectations. So as you can see, there's many closing challenges. And when I said before, the better off you can get in negotiations and the letter of intent, the better off that you're going to have less challenges throughout that, and you're going to have a smooth close. So for a smooth close, you're going to establish realistic expectations, understanding that there's negotiations and that's two-sided. So you have to go into a transaction willing to negotiate. You want to resolve issues earlier. You can't let them pile up, because once they pile up, that's when they become a deal breaker. So you want to negotiate each issue independently and move forward. You need to maintain performance during this process, right? The business needs to continue as it always had. There can't be a lag of performance during this process. And then you need to leverage your advisors. You only do this, a lot of business owners only do this once during their lifetime, and it's really exciting. And your advisors will help you get there. And ultimately, through a smooth closing, you'll get the best value for your business, and all your objectives will have been met.
Thank you, Nikki and Craig. That was some great information. Hopefully, everybody got a little bit of information. And I think as we started this conversation, prepare, prepare, prepare. A transition takes time, and so we can help you with that preparation process. So we invite you to join us for our fourth and final webinar in this series, which will take place on July 22nd. If you scan the QR code, it will take you to the registration. And if anyone has any specific questions, I apologize, we went a little bit over. Please reach out to us and we will address any of those questions. Thank you so much, and everyone have a great day.